Welcome back to the quarterly call. All content is for informational purposes and is not investment advice. Please consult with an investment professional.
Hello, everyone, and welcome. Today, we're taking a closer look, a real detailed look, at a major player in the engineering solutions world, Synopsys. Their recent Q3 2025 financial period was, well, it was really quite something, a real saga, you could say. We're talking about a quarter where they made these huge strategic moves, but at the same time, they hit some pretty unexpected turbulence.
Yeah, it was definitely a mix.
It really is a compelling story. Ambition, strategy, evolution, and just that relentless drive you need in this industry. Innovation, adaptation, it never stops moving.
That's right.
So we'll be digging into the decisions, the market forces that really shaped their performance recently.
Absolutely. And when you look into Synopsys' Q3, there are really two very strong, very distinct stories playing out. Each gives you a unique perspective on where the company is and, importantly, where it's headed.
So on one hand, you've got this landmark acquisition, a huge move. It doesn't just, make them bigger. It fundamentally rewrites their identity as a global leader.
Right. Redefines them.
Exactly. But then on the other hand, you see these surprising headwinds hitting a business segment that's historically been really strong for them. And that's forcing some, let's say, critical thinking about strategy. Understanding how these two dynamics intertwine, it's not just about analyzing one company. It really gives you crucial insight into the wider tech and AI landscape. It shows just how fast even the big leaders have to pivot sometimes.
That's a great point. So for you, our listener, here's the plan for navigating this. We're going to start with the really big news, the kind of thing that ripples through the industry, signals a whole new direction.
The acquisition.
Exactly. Then we'll get into the more nuanced challenges they ran into, explore the specific market pressures, the internal choices that led to some unexpected results.
Yeah, the IP side of things.
Right. And finally, we'll look at how Synopsys is setting itself up for the future, making some tough, but, calculated moves to stay resilient and lead the way. This isn't just a numbers discussion. It's about strategy, innovation, adapting in this incredibly fast world. So let's get into it.
A transformational quarter.
Yeah.
The Ansys acquisition takes center stage.
Okay, speaking of transformative changes, let's dive right into the headline event for Synopsys in Q3. Closing the Ansys acquisition. Management themselves called it a transformational milestone quarter.
Yeah.
And hearing that from a company like Synopsys, it really tells you something about the significance of this move. This isn't just, adding a piece. It feels really foundational. A big shift.
It really is. And what's truly fascinating here is the strategic weight of this deal. Synopsys, for decades, they were the name in EDA, electronic design automation.
Right. The chip design guys?
Exactly. They basically wrote the book on designing complex chips. But now, with Ansys integrated, they are very deliberately, very powerfully repositioning, moving beyond just EDA to become a, and this is their term, global leader in engineering solutions from silicon to systems.
Silicon to systems, okay.
Yeah. And that's not just marketing speak. It represents a huge, ambitious expansion of what they do. Their core mission, their capabilities. They're going from designing the chip itself to designing the whole product that the chip powers.
So let me make sure I'm getting this right. The Ansys deal is sort of a strategic response to the rising costs and complexity, especially in AI design.
Yeah.
But does that shift, water down their core EDA strength, or is it just a natural next step? What's the real why behind such a massive deal right now?
That's a really critical question. And no, I don't think it's dilution. I think it's a necessary evolution. If you connect it to what's happening in tech generally, the why really comes down to, accelerating complexity, soaring development costs, and this relentless pressure to get products to market faster, especially these next-gen AI systems.
Right. The time pressure is immense.
It is. And designing these systems isn't just about making the silicon perfect anymore. It's about how that silicon interacts with the physical world around it. How it handles heat, vibration, environmental stress, how it behaves under real operating conditions.
Okay, so more than just the digital design.
Exactly. Think about an AI chip going into, say, an autonomous car or a smart factory robot or maybe an advanced medical device. Synopsys used to focus on the brain, the chip design itself. Now with Ansys, they're bringing in these world-class simulation and analysis tools. They directly address those critical body challenges. How does the whole thing work together?
Yep.
This combined power lets customers simulate the entire system. From the tiniest transistors on the chip all the way up to the full car or the robot arm. And they can do this long before they build anything physical.
Wow. That must save a ton of time and money.
Huge amounts. It massively de-risks the whole development cycle. And in areas like automotive or medical, where failure isn't just expensive, it can be, dangerous.
Yeah.
That's invaluable.
That makes a lot of sense. And you mentioned physical AI. That term really seems to capture this integration. What does physical AI actually mean for the R&D teams out there trying to push the limits?
Physical AI, yeah, it really points to a fundamental shift in product development. It's about optimizing design, not just for, say, raw computing speed or power efficiency, but crucially for how these AI-driven products will actually perform and interact reliably out in the real physical world.
Okay, give me an example.
Sure. Imagine designing a new industrial robot run by AI. It's not enough for its chip to process data fast. That robot has to work perfectly in different temperatures, handle specific physical loads, avoid breaking down from stress, manage its own heat, all that stuff.
Right, the real-world messiness.
Exactly. So with Ansys simulation tools, R&D teams can create these incredibly detailed digital twins of the whole system.
Digital twins, okay.
Yeah. It lets them predict, test, and fine-tune how a new AI system will behave under, well, almost any real-world condition you can think of. Extreme temperatures, physical stresses, how air flows around it, electromagnetic interference.
So you test it virtually first.
Solely. It's about building in that real-world reliability and performance right from the start of the design. You cut down on expensive physical prototypes, you speed up validation. It's a huge advantage.
That is a powerful concept. And how quickly are they actually integrating this? Are we seeing any early results, any highlights of what this combined power delivers to customers already?
They're moving surprisingly fast, actually. One really notable early integration, and it shows the strategic alignment, is embedding NVIDIA Omniverse technology right into Ansys simulation tools.
NVIDIA Omniverse, what does that enable?
It's a potential game changer, especially for developing autonomous systems. Think about engineers creating these incredibly realistic virtual worlds where they can develop, train, test, and validate self-driving cars or robots much, much faster and with more confidence than before.
Ah, so virtual testing grounds.
Exactly. It drastically cuts down development time for really complex, safety-critical systems. Another area seeing early impact is what they call multi-die momentum.
Multi-die momentum.
Yeah, this involves integrating Synopsys' deep expertise in semiconductor timing and power sign-off, basically making sure the chip works right and efficiently, with Ansys, what they call the gold standard of thermal sign-off.
Thermal sign-off, so managing heat.
Precisely. Heat management is absolutely critical in today's complex stacked multi-die chips, especially for these high-performance AI processors that generate enormous amounts of heat.
Right.
They expect to deliver their first fully integrated solution, combining these crucial capabilities in the first half of next year.
Wow, that's quick.
It's incredibly quick. It really speaks volumes about the synergy they're aiming for.
That really is a powerful combination, merging the digital brain with the physical body, so to speak. Beyond the tech synergies, what about the wider business impact? How does Ansys help Synopsys, spread its bets a bit? Diversify.
Oh, hugely, and very strategically. Ansys significantly diversifies Synopsys' customer base globally and its whole product portfolio. Synopsys, historically, was heavily reliant on the semiconductor industry.
Which can be cyclical.
Exactly. Very lucrative, but also exposed to the ups and downs of that specific sector. Ansys, though, brings these strong, established relationships and deep solutions in really critical adjacent industries. Think automotive, with its strict safety needs. Aerospace and defense, with long design cycles. Industrial IoT, advanced materials.
So new industries, new customers.
Right. And it's not just about adding logos. It's about embedding Synopsys' influence deeper into the design cycles of industries where AI and advanced simulation are becoming absolutely essential, non-negotiable.
Okay.
This expansion builds layers of business resilience that their traditional semi-focus couldn't achieve on its own. It effectively spreads their risk across a wider, more diverse economic playing field.
So it's not just bigger, it's broader, more resilient. How did Ansys actually do in Q3? I know it was only under the Synopsys umbrella for a couple of weeks. And what's the outlook for growth from this new segment?
Yeah, it's early days for sure. Ansys contributed revenue for about 2 weeks in Q3. The vast majority of that showed up under the simulation and analysis product group. And management said these products performed in line with expectations.
In line. Okay, that sounds stable.
It is. It's subtle, but it's a really important signal. Despite this massive acquisition, they seem to be integrating a healthy, well-run business without major disruption, which isn't always the case in big mergers. This smooth financial start builds a good foundation for actually achieving those silicon-to-system synergies, maybe faster than people expect. Plus, Ansys hasn't slowed down its own innovation. They just released Ansys 2025 R2.
Okay, what's new there?
Significant advances in AI-driven simulation, GPU acceleration, system-level modeling, things that immediately extend Synopsys' existing AI leadership right into the simulation space. It reinforces their combined edge.
So the innovation continues.
Absolutely. And management's outlook has been notably positive. The CEO even said there were no surprises, actually, except pleasant ones, about the integration so far. That's pretty high praise for such a complex merger.
That is encouraging. Did analysts ask specifically about how Ansys would drive growth now that it's part of Synopsys?
Oh yeah, definitely. Analysts were really keen to understand the specific growth engines for Ansys. Management pointed strongly to opportunities in 3D ICs.
3D ICs, three-dimensional integrated circuits.
Exactly. For the listener, these are advanced chips where you stack multiple specialized dies, smaller individual chips, vertically in one package. Huge performance benefits for AI and high-performance computing.
But complex to design, I imagine?
Immensely complex, especially around thermal management, structural integrity, fluid dynamics within the package. Ansys's tools are essential for tackling these issues, so it's a natural fit to accelerate innovation in this really cutting-edge area. Demand for these advanced packages is skyrocketing with AI, and Ansys is perfectly placed to meet that.
Got it. And what about the Ansys channel business? That sounds like a different way of operating compared to Synopsys' typical direct sales model. How are they thinking about that?
That's a great question. How do you leverage all the strengths you acquire? Ansys has this really well-established channel business, about 25% of its operations.
A quarter of the business, wow.
Yeah, it's significant, and it's a big new opportunity for Synopsys. Historically, Synopsys relied more on direct enterprise sales for its complex EDA tools. This channel gives them a chance to potentially reach new customers, maybe extend the reach of some of their own complementary products through this existing network of resellers, especially for maybe less complex, more standardized tools.
Interesting.
But it's also crucial they manage it well. They need to keep those Ansys channel partners happy and serviced effectively, keep that revenue stream flowing. It's a powerful distribution network they've acquired, and figuring out how to maximize it across the whole combined company will be key. It shows M&A isn't just about tech, it's also about market access and sales strategy.
Navigating headwinds, the design IP business under scrutiny.
Okay, but even in a quarter dominated by such a huge positive acquisition story, there were some shadows. Let's switch gears now and look at an area that faced unexpected turbulence: their design IP business, intellectual property. This segment actually saw a pretty significant underperformance, down 8% year over year. That definitely raised some eyebrows, given its historical strength and how critical IP is for chip design.
It did. It's a really striking contrast to the positive Ansys narrative. Management was quite open about it, though. They pointed to three main factors behind this underperformance. And understanding the details of each is really key to getting the full picture. It shows how even a market leader can get hit by external shocks and tough internal choices.
Okay, let's break them down. What was the first factor hitting the IP business?
The first was the immediate and pretty significant disruption from export restrictions affecting their business in China.
Ah, the China restrictions.
Yeah. These directly hit design starts, which for the listener is when customers kick off a new chip design using Synopsys' pre-designed IP blocks. But what's really interesting, and management stressed this, is that the impact on customer behavior lasted much longer than the initial 6-week restriction period.
Longer? Why was that?
Because it created this deep, lingering uncertainty, customers started asking serious questions. If we commit to Synopsys IP for a multi-year project, can we actually finish it? Can we tape out the chip? That's the final sign-off before manufacturing. They worried if future restrictions might suddenly halt their project midway.
So long-term confidence was shaken.
Exactly. It shows how even short-term geopolitical events can create lasting hesitation in long investment cycles. It fundamentally shifted how and when companies decided to commit resources for critical designs in that region. A real lesson in geopolitics impacting tech roadmaps.
That makes total sense. That kind of instability can really cause delays for years. Okay, what was the second factor behind the IP headwinds?
The second was tied to unexpected challenges at one of their major foundry customers, a big one.
A foundry customer, so one of the big chip manufacturers.
Right. Management said this had a sizable impact on their IP business. They put it down to a mix of market-driven reason and customer-related reason, basically things outside Synopsys's direct control. What's particularly revealing here, and it highlights the risk when you have concentrated exposure to big customers, is that Synopsys had made significant investment building out specialized IP just for this customer. They were expecting good returns.
And those returns didn't come through.
Unfortunately, they did not materialize as planned. It's a classic situation. You invest heavily to support a key client's roadmap, but if that client's own market or strategy changes, your expected ROI can just evaporate.
Ouch.
Yeah. When an analyst asked about it, management basically said they remain committed to supporting customer choices on tech nodes, signaling they'll stick by customers technically, even if the commercial side gets tricky. It's a tough balancing act.
Definitely. And the third factor, was that external too or more internal?
The third was more internal. It came down to Synopsys' own strategic roadmap and resource decisions. Specifically, they noted investments made to chase edge AI opportunities.
Edge AI, so
Yeah.
AI on devices themselves.
Exactly. Like smart cameras, drones, IoT sensors, investing there came at a roadmap cost. It meant making tough choices about which foundries to prioritize for other IP development. And it also led to data center delay in some of our IP titles.
So trade-offs.
Big trade-offs. It shows you can't be everywhere at once in a hot market like AI. Prioritizing edge AI meant, inevitably, deprioritizing or delaying some other things, like certain data center IP, at least short-term. Those delays, even if strategically right for the long haul, meant missed revenue in Q3. It's that constant juggle between chasing new trends and serving existing markets.
So yeah, these are definitely significant headwinds, a mix of geopolitics, major customer issues, and internal strategy shifts.
Yeah.
What's the outlook then for this IP segment? Are these permanent problems or more temporary?
That's the million-dollar question, right? Analysts pushed hard on this. Management was pretty straight, saying they expect a transitional and muted year in IP as we look ahead into FY 2026.
Muted for a whole year into 2026.
Yeah. So clearly not just a Q3 thing. They're resetting expectations for the next year, or maybe even two. Think of it like hitting a rough patch in a race. You adjust your pace, rethink your strategy for the next leg.
But they're not giving up on IP.
No, not at all. They were very firm that the long-term opportunity in IP is absolutely strong, especially with AI driving demand. So the underlying market is still robust. The issue isn't lack of demand. It's about execution, adaptation, and navigating these current challenges.
Okay, so they're not just waiting it out. What are they actively doing to fix these IP issues and get that segment growing again?
They're definitely being proactive. They know it won't fix itself. The company is actively pivoting our IP resources and roadmap towards the highest growth opportunities.
Pivoting resources, how?
A key move was merging two engineering teams, the standalone IP team and their system solution group, which does more customization work.
Combining forces.
Exactly. The explicit goal is to accelerate their ability to deliver on new opportunities, especially as the market itself shifts.
How is the market shifting?
The demand is moving away from just licensing individual IP blocks. Customers increasingly want more sophisticated subsystems and chiplet-based solutions.
Chiplets, like Lego bricks for chips.
That's a great analogy. Smaller, pre-verified functional blocks you can assemble into complex custom processors. It means customers want more integrated, optimized solutions, not just components. It's a higher level of complexity and value.
That sounds like it could change how they make money, too. Are they rethinking their IP business model, especially for these more complex custom deliveries?
This is where it gets really interesting, potentially hinting at future industry models. Management specifically mentioned they're talking to customers about a combination that does include some sort of a royalty for these highly customized subsystems.
It's a royalty instead of just upfront fees.
Potentially alongside, or instead of the traditional NRE non-recurring engineering fees, which are one-time payments for design work and simple use fees. A royalty model means they'd get an ongoing piece of the value as those custom solutions are manufactured and sold over time.
Capturing more long-term value.
Exactly. It reflects the higher value and deep customization they're providing. It could also create a more predictable, recurring revenue stream for them over a product's life. It's adapting the business model to match the evolving market complexity, especially for these high-value custom jobs.
And with all this demand for more complex integrated IP, are they struggling to keep up? Do they have enough capacity?
That's another challenge they acknowledged. Management said demand for this advanced IP is actually outstripping their current ability to deliver it all.
A good problem to have, maybe.
In a way, yes. It shows strong market pull, but you need to solve it efficiently. Their plan is to leverage AI and new methodologies internally to deliver IP faster and with higher quality.
Using AI to build AI tools, essentially.
Right. It's a crucial internal efficiency play. They realize just hiring more people isn't always the best long-term solution. It's about working smarter, using their own AI expertise to boost their output, streamline verification, and get more high-quality IP to market quicker. Tackling the capacity crunch with tech innovation.
Resilience and innovation EDA and the AI differentiator.
Okay, so despite those headwinds in the IP business we just discussed, there's this really strong counterstory happening elsewhere in Synopsys. Let's pivot back to their core, their design automation segment. This part showed incredible resilience, really strong performance in the same quarter. How is this part of the business doing so well?
Yeah, this is where that huge overarching trend of AI really shines through. It's acting as a massive catalyst. The success in design automation is directly linked to the enormous investments and the surging demand driven by the AI boom.
Because designing AI chips is so complex.
Insanely complex. Designing silicon specifically optimized for these AI workloads creates this almost unending need for Synopsys' most advanced EDA tools. This segment is right at the heart of enabling the whole AI revolution, which makes it incredibly strong right now.
So, what did the numbers look like for design automation, and which specific products really drove that success?
The design automation segment brought in $1.31 billion in revenue. That's up a very healthy 23% year over year.
23%, wow.
Yeah, impressive growth. A lot of it was driven by strength in their hardware business, which means their emulation and prototyping solutions.
Emulation and prototyping, why are those so critical for AI?
Because these AI chips are so complex, you absolutely have to verify them rigorously before you spend millions or even billions manufacturing them. Synopsys' tools for this, like their ZeBu server and HAPS systems, are essential. They shipped record ZeBu Server 5 and HAPS 200 ZeBu 200 units. These systems let designers test and validate incredibly complex chips and software before manufacturing, saving potentially fortunes in costly redesigns.
Okay, catching errors early.
Crucial. Plus, they locked in multiple competitive wins with leading hyperscalers.
The big cloud companies.
Right. Think AWS, Google Cloud, Microsoft Azure. And they secured a multi-year commitment with a leading AI customer. These wins really cement their leadership position in enabling next-gen AI chip design. It shows the biggest players rely on Synopsys to get it right.
That's a massive vote of confidence from the most demanding customers out there. It really sounds like AI isn't just something they're reacting to. It's a core part of their differentiation, their product strategy.
Absolutely. Synopsys' AI capabilities are way more than just a feature. They're becoming a fundamental competitive advantage woven right into their tools. They mentioned that roughly 20 customers are broadly piloting Synopsys, that AI, Gen AI-powered capabilities.
20 customers piloting Gen AI tools, that's significant.
It is. These aren't just small tests, they're broad strategic engagements. They're also talking about this concept of agent engineer technology. Their vision is for AI to evolve from just being a helper, for engineers, to actually being a doer.
A doer. What does that mean in practice?
Imagine AI not just assisting with tedious tasks, but autonomously doing complex design exploration, finding optimal solutions, maybe even generating sophisticated design blocks itself. For you, the listener, think of an AI agent analyzing millions of possibilities to find the absolute most power-efficient layout for a critical part of a chip, or automatically checking hundreds of complex design rules. It frees up human engineers for higher-level thinking and innovation.
That sounds truly transformative for engineering itself.
It really does. And remember that Ansys 2025 R2 release we talked about, with its AI-driven simulation, that extends this AI leadership across their entire expanded portfolio now. It creates this unified AI-powered design flow from the silicon all the way to the full system.
And is that multi-die momentum we discussed still a big factor in this design automation success?
Yes, definitely. The push towards multi-die solutions is still going strong, and it directly fuels demand for their advanced EDA tools. They've enabled multiple successful tapeouts for top AI chip companies, highlighting just how critical their role is in this cutting-edge design approach.
Because packing multiple chips together is the way forward for AI performance.
It seems to be. As AI chips get more specialized and power-hungry, packaging multiple high-performance dies together in one system is often the only way to hit the necessary performance and efficiency targets. This creates huge new design and verification challenges.
Which Synopsys tools help solve.
Exactly. Their advanced EDA tools are uniquely positioned, especially now with the Ansys integration handling the crucial thermal and mechanical aspects. It's clear that the combination of their traditional EDA strength and the new Ansys capabilities puts them in a really strong position for the future of advanced packaging, which is absolutely central to the future of AI hardware.
The financial pulse and future guidance.
Okay, so we've hit the strategic highs with Ansys, the challenges with IP, and the innovation driving EDA. Let's pull it all together now and look at the overall financial picture for Q3, and crucially, what Synopsys is telling us about the rest of the year. It's clear both the huge Ansys deal and those IP issues really shakes these numbers.
Yeah, and what's interesting is how these numbers really tell a story of careful navigation and strategic thinking in a really dynamic market. For Q3 itself, total revenue came in at $1.74 billion. That's up a solid 14% year over year.
13% growth, okay.
Non-GAAP EPS, earnings per share, was $3.39. And their non-GAAP operating margin held up well at 38.5%.
Pretty healthy margin.
Very healthy. And their backlog, which now includes Ansys, is a really robust $10.1 billion.
$10 billion in backlog. That's huge.
It is, and management specifically pointed to it as underscoring the resilience of our business. It provides a strong base of future contracted revenue. Geographically, they saw good strength in Europe and North America. China saw some sequential improvement, but as we discussed, those headwinds were definitely still felt there.
And cash, debt.
Cash position looked good. Ended the quarter with $2.6 billion in cash and short-term investments. But, and this is the flip side of the Ansys deal, total debt jumped up significantly to $14.3 billion.
$14 billion in debt. That's substantial.
It is, but it's directly tied to funding that massive strategic acquisition. Free cash flow for the quarter was around $632 million, showing strong operations despite the big investment.
And how do the margins look when you break them down by segment? Reflecting that split performance between design automation and design IP.
Yeah, the difference is really stark in the segment margins. Design automation, the strong performer boosted by AI, posted an adjusted operating margin of 44.5%. Really profitable, really efficient.
44.5%, wow.
Yeah, but then design IP, its adjusted operating margin was much lower, down at 20.1%.
Oof, big difference.
Huge difference. And that lower margin was a direct result of the lower revenue from those headwinds we talked about, combined with the fact that they're continuing to invest strategically in the IP roadmap to pivot for future growth.
So taking a hit now to invest for later.
Exactly. It shows the immediate financial costs of both the market challenges and the necessary strategic reinvestment needed to turn a segment around. It's a calculated move, absorbs some short-term margin pain for long-term strategic gain.
Okay, so given all these moving parts, the mixed results, the massive acquisition, what does the updated guidance look like for the rest of fiscal 2025?
Yeah.
Must be tricky to forecast.
Very tricky. The guidance was definitely updated to factor in both Ansys and the fact that those IP headwinds are expected to continue. Management explicitly said they're taking a conservative view on Q4.
Conservative? Okay. Prudent.
Yeah, seems realistic given the uncertainties and the ongoing integration. For the full fiscal year 2025, the revised revenue target is now $7.03 billion to $7.06 billion.
$7 billion plus.
Right. Non-GAAP EPS is projected between $12.76 and $12.80. Free cash flow for the whole year is now expected around $950 million.
And that cash flow number is lower than before.
Yes, it is lower than prior expectations, mainly due to two things. The lower revenue expected from the IP segment and the increased interest expense from the new debt taken on for Ansys. Direct financial impacts of both the challenge and the big strategic bet.
Got it. And Q4 specifically?
For Q4, they're guiding revenue between $2.23 billion and $2.26 billion, and non-GAAP EPS of 2.76 cents to $2.80.
I think an analyst asked about the Q4 operating margin dipping a bit. What was the explanation there? Should people be worried?
That's a really important clarification they made. Management stated very clearly that the expected dip in Q4 operating margin is primarily due to the IP business underperformance and the continued investment in fixing that roadmap.
So it's not Ansys dragging it down?
No, exactly. Ansys actually came in with higher operating margins and is expected to be accretive, meaning it should help margins overall. The pressure is localized to the IP segment and the resources being poured in to turn it around.
And they still believe in higher margins long term.
Yes, they reaffirm their long-term commitment to getting operating margins into the mid-40s range. So the message to you, the listener, is that management sees this Q4 pressure as a short-term, necessary adjustment to fix a specific problem and pivot for growth. It's not seen as a fundamental, long-term weakening of their overall profitability goal. It's investment pain for strategic gain.
And with all that new debt from Ansys, how are they planning to manage cash flow and pay that down? $14 billion is a lot to handle.
Yeah, financial discipline becomes key here. It's a critical part of post-acquisition strategy. They ended Q3 with that healthy $2.6 billion cash buffer, well above minimum needs. They plan to start paying down the principal on the term loan starting next year. Those are due in 2027 and 2028, so there's a clear debt reduction plan.
Okay. Any other cash coming in?
Yes, they're also expecting a significant cash inflow when the divestitures of their Optical Solutions Group and Power Artist business finally close. That's pending final regulatory approval for the buyer. That cash will provide more firepower to manage the debt and reduce leverage over time. It shows they have a solid plan to handle the increased debt load and get back to a more optimized balance sheet.
One last point on Ansys financials, it's his historical seasonality. You know how some quarters are typically stronger than others? How does that fit into Synopsys' calendar now?
That's a good practical question. When you merge big companies, aligning calendars and cycles matters. Ansys has now conformed to Synopsys' fiscal calendar. Historically, Ansys had a really strong Q4, usually November-December, because big software deals often close at year-end.
Right.
Now, with the alignment, a lot of that historical Ansys Q4 strength will actually fall into Synopsys' Q1. So Synopsys' Q1 will likely get a bigger seasonal boost from the Ansys business going forward.
Interesting. Will that change over time?
Management suggested it might. They talked about potentially smoothing out the seasonality over time by aligning Ansys' business models more closely with Synopsys' typical subscription model.
Moving away from big upfront deals.
Potentially shifting more towards that consistent recurring revenue recognition instead of the more traditional lease and upfront license models Ansys used. That would lead to smoother, more predictable financials quarter to quarter across the whole company. But that's more of a longer-term strategic goal to optimize financial predictability.
Optimizing for the future strategy and headcount.
Okay, beyond the immediate financials and guidance, let's look ahead. What are the forward-looking strategic actions Synopsys is taking? This is where we see them really planning for the long term, building efficiency, not just reacting.
Yeah, these moves are absolutely central to their big picture plan, solidifying their leadership and making that silicon to systems strategy a reality. It's not just about tackling today's issues. It's about proactively shaping their future in this incredibly fast-moving tech world, building a foundation for sustainable long-term growth.
So what's item number one on that future-proofing agenda?
First up, they're conducting an ongoing strategic portfolio review. And this isn't just a quick look. It sounds like a really rigorous company-wide process, critically examining every investment, every execution priority.
What's the goal?
The goal is to laser focus their resources, money, talent, effort purely on the highest growth opportunities, making sure every bit of investment goes where it will have the biggest strategic impact and return. It's about being lean, agile, super focused, especially now as they integrate Ansys and pivot the IP business, reallocating capital and people to the areas with the most potential.
And this strategic review, it connects to a fairly significant announcement about their workforce size, right?
Yeah.
Headcount changes always get a lot of attention.
Yes, it does. They announced a planned global headcount reduction of roughly 10% by the end of fiscal year 2026.
10% by end of FY26, that's a big number. What was their reasoning?
They gave a few reasons: achieving greater scale and efficiency across the much larger combined company, accelerating that overall silicon to systems strategy by streamlining things, and optimizing their cost structure for better long-term profitability.
Okay. But was this purely a reaction to the recent IP problems?
That's a crucial point they made. Management explicitly clarified this reduction was planned, irrespective of the current and anticipated unpleasantness in IP. So it wasn't just a panicked reaction to Q3's IP numbers. It was part of a broader, pre-planned efficiency drive that was already in the works. It signals a more proactive approach to getting the whole organization running optimally.
So not just cost-cutting for a bad quarter. It's a bigger, more fundamental push for efficiency tied to their long-term vision. What else are they doing to get more productive and achieve that scale?
Exactly. The headcount reduction is just one piece of a larger initiative. They're aggressively deploying custom Gen AI, generative AI, tailored for them internally across their operations. And they say it's already boosting productivity.
So using their own medicine, so to speak.
Right. They're not just selling AI tools, they're using them to optimize their own work, from software development to customer service. Alongside that, they're doing a deep review of management layers, processes, internal systems, looking for overlaps, ways to streamline things.
Okay, AI plus organizational review.
Yeah. The combination of AI productivity gains and smarter organizational structure is expected to create significant, lasting efficiencies. Doing more with less, essentially, but with higher quality and better strategic focus, leveraging tech and smart design to scale effectively.
And how does all this efficiency work, including the headcount changes, tie back into the Ansys merger? Is it meant to speed up getting the benefits from that huge deal?
Oh, absolutely. These actions are directly expected to accelerate our synergies,
Yeah.
the benefits they promise from the Ansys merger. When you put two big companies together, there are always opportunities to combine functions, cut redundant processes, consolidate resources.
Right, finding the overlaps.
Exactly. This efficiency drive is explicitly designed to capture those opportunities faster, delivering the promised operational and financial gains sooner than might otherwise happen. It's about getting the full value from the Ansys acquisition faster and better by creating a leaner, more agile, combined company. Strategic integration in action.
We started off talking about how Ansys helps them diversify. Does that still hold true as part of this forward-looking strategy, especially given things like the China headwinds?
Most definitely. That diversification benefit from Ansys is arguably more critical now than ever. Ansys, historically, has very different business profiles in different regions. For example, their percentage of business in Europe versus China is quite different from Synopsys' traditional semiconductor focus.
So the combined company is less exposed to any single region.
Exactly. It makes the whole entity inherently more resilient to regional economic swings or specific geopolitical issues that might hit one market harder than another. It builds a broader foundation for revenue and customer engagement, insulating them better from localized shocks. Makes the overall business more stable and predictable in what's clearly an unpredictable world. Strategic diversification, providing geopolitical resilience.
It really sounds like a bold, comprehensive vision, combining a massive acquisition, tough internal reevaluation, and future-proofing with AI. How does management kind of sum up their grand strategy here?
Their big tagline, their vision statement, is that Synopsys is re-engineering engineering.
Re-engineering engineering, that's ambitious.
It is. It's a powerful statement. It says they're not just tweaking existing tools. They believe they're pioneering entirely new solutions that will fundamentally change how engineering gets done, from the tiniest chip component up to the most complex system. It's not just about incremental improvements. It's about enabling the next wave of innovation in this incredibly complex, connected, AI-driven world. Their mission is to empower engineers to solve problems that were maybe unsolvable before, really pushing the limits of what's technologically possible. Outro. And that brings us to the end of our look into Synopsys' Q3 2025. What we've really seen is a company in the midst of a major strategic transformation, skillfully balancing the huge potential of a massive acquisition against the need to make targeted, proactive fixes for specific market challenges. It's a really fascinating glimpse into how even the biggest industry leaders have to constantly innovate, adapt, and sometimes make difficult choices to secure their path forward. Yeah, what this whole discussion really underscores, first for you, our listener, is that complex interplay between big strategic bets like acquisitions, unexpected bumps in the road like market headwinds, and then the proactive internal reshaping, like the efficiency drive. How do all these pieces fit together? It really reflects the sheer dynamism, the constant challenges inherent in high-tech today, especially in sectors tied so closely to the breakneck speed of AI and semiconductor design. This story really offers a compelling look at the agility, the foresight, and, frankly, the sheer determination needed not just to keep up, but to actively try and redefine leadership in this landscape. It definitely leaves you wondering, what are the next frontiers for re-engineering engineering that might emerge from all these strategic shifts they're making?
A great question to ponder. Thank you so much for tuning into the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.